Let me welcome in Saurabh Mukherjea, who's joining us on the show. Saurabh, good to have you with us. Let's just start off with the kind of momentum we're continuing to see, Saurabh, approaching 11,000, everything looking pretty much on track, and commentary also continuing to be fairly bullish. Global liquidity, there doesn't seem to be any kind of hiccup or pause coming. Do you feel that the path ahead remains pretty smooth, given that currently all the factors seem to be very much in place?
I think in a sort of ironic way, right? These sorts of stop-start lockdowns, which I think I was hearing Nikunj refer to a few minutes ago. These stop-start lockdowns, whether it be in the United States or in India, this actually is ideal from a liquidity perspective because it almost assures us of a slow recovery, perhaps even an uneven recovery. And obviously that means that the central banks around the world, including our central bank, will have to keep the accelerator fully pushed down on the liquidity tab. So whether it's BOJ, Federal Reserve, or the RBI, I think liquidity will be sloshing around abundantly for the next couple of years. And from a financial markets perspective, whether it's stocks or bonds, that's good news. That's good news. So slow recovery, ideal for stock markets. And I think from that perspective, I think we're in a pretty good spot at the moment. A slow recovery rather than a rapid recovery from COVID means plenty of liquidity, and that puts a base, that puts plenty of support on the stock market. Yeah, this actually is ideal from a liquidity perspective because it almost assures us of a slow recovery, perhaps even an uneven.
Saurabh, in light of that then, we have seen a spate of fundraising across the financials. Now we're looking at several other major business houses, Tata Sons today in a board meet. That fundraising drive seems to continue when it comes to India Inc. In light of what you've just outlined, where do you see the opportunity going ahead? I know you've described your strategy very clearly before, but as investors continue to try and get a handle on where the opportunity lies in this market.
So I think just linking to the preceding question you asked, one very interesting thing about the events of the last 4, 5, 6 months has been because of the ferocity of the central bank intervention, there is no shortage of risk capital, whether it's risk capital abroad, risk capital in India, in the bond market, or indeed in the venture capital space, right? So you've got to keep that in mind that although COVID is playing out, risk capital and capital in general is abundant. So what's happening in our country, we can see this in full glare of daylight. The strongest banks, the strongest NBFCs, even outside banks and NBFCs in manufacturing, say Aditya Birla Fashion Retail, the stronger companies are going up and loading up on money. Right, money is available, whether it's QIPs or rights issues. Strong money is available every single day. I think RIL underscores that point. And what that will allow them to do is, as we go into the sort of longer-lasting effects of COVID, the longer-lasting effects of COVID will come through, right? Businesses will shut down, are shutting down, and as the moratorium comes to an end from September, we will feel the more painful effects of COVID. These stronger businesses will use their enhanced capital position to consolidate market share. So this effect will play out across several sectors, but my reading is it will be most pronounced in lenders, banks and NBFCs. So the stronger banks and NBFCs are loaded up with capital. They will consolidate market share. I really fear for the PSU banks and for the weaker lenders in our country. I think from September onwards, unless the RBI extends the moratorium, from September onwards, I think there'll be plenty of balance sheet blowouts amongst the weaker lenders. And the other two areas, if you ask me, auto, right? Auto ancillaries, especially auto, it's relatively clear that there is a pretty nice recovery underway. The Hyundai CEO was talking about how quickly the numbers have recovered in India. Maruti's production has recovered quickly. Pawan Munjal Saab has talked about how Hero's numbers have recovered. So auto, lenders, and the third area, this whole API story, which I think discussed last time on your channel, that seems to be playing out nicely. The government has taken a clear point of view that India needs to make more APIs. We are very dependent on China today. Even if 5% of Chinese API manufacturing moves to India, we double up our API production. So the pharma intermediates feeding into the API industry, auto ancillaries, and lenders in 3 sectors where the remainder of this fiscal will bring plenty of tangible action from which your viewers can make money.
Saurabh, there is going to be a lot of spend towards healthcare. All of us perhaps will take measures, extraordinary measure to protect our health, something which I think is a universally accepted fact. Now, at a macro level, government is spending more towards increasing spend on healthcare. Individually, if healthcare was accounting for 2-3% of our total wallet spend, it could go to 5 to 10%, depending on whom you are asking. Now, this is a mega trend, Saurabh, which is in making. So the question I want to ask you is that how does one participate when we know that this pie is going to be an increasing pie in terms of the total demand and total spending?
Yeah, absolutely right. I mean, even without COVID, all the data suggested that we were spending a greater and greater part of our national income on health. And if you look across the world, we are at $2,000 per capita income. Global data suggests all the way to $10,000 per capita income. Countries spend more and more of their income on healthcare. So we too should follow that trend. There are two challenges though in making money out of healthcare. First is whichever government, wherever governments get involved in healthcare, they try to squeeze the profits out, right? It's a global thing, not just an Indian thing. And therefore, just because governments will get more involved doesn't mean that the private sector and us as investors can make more money. And the second thing is, even where, say, it's a private sector hospital or it's a private sector pharmaceutical company, because the regulatory levers lie with the government, it isn't that easy to make, high ROCs, right? That being said, there are, I think, three ways I can think of where this trend will come through and allow you and us in the stock market to profit. I think the first area is obviously path labs, right? We need way more path labs than we have. I think 70-80% of the path lab sector is informal, mom and pop shops. Clearly there'll be modernization and consolidation. And in several of our portfolios, we have Dr. Lal Path Labs. That's what I think is the most efficient play on that. The second is this API point I was making. It's a national security issue. We are at the moment completely dependent on China for our APIs. I don't think the government wants that to continue. Therefore, there will be a lot of relocation of API manufacturing to our country, and a whole pharma intermediates and API manufacturing industry opens up. Divi's Lab is our play on that. And the third is insurance, right? As you rightly pointed out, Nikunj, the psychological blow of COVID is pretty powerful. And my reckoning is health insurance, and specifically COVID insurance, comes to the fore. There are, to my mind, only two good health and general insurers in our country. We've got one of them in our portfolio, ICICI Lombard, but I think health insurance generally will become a big deal. Most families who can afford it will end up buying it. So health insurance, APIs, and the whole ecosystem around path labs and testing. I think those are the three ways I would think we can make money. Not so much the hospital piece and not so much the formulations piece. Those two, I reckon, are challenged from a profitability perspective.
It's a great point. I was speaking to a path lab company yesterday, and they clearly are of the view that the quarter gone by will be a bad quarter, obviously because of lockdown. But going forward, COVID testing, antibody testing is something which is going to be adding a large part to their revenue line on a permanent basis. And to coming to Saurabh's point, unorganized is getting crunched out, and smaller, single unit path labs which had a regional presence, had one or two laboratories, one or two shops associated with regional doctors, they would be in for a tough time. Saurabh, why is that cement, steel, some of these companies, they have never excited you? I mean, these stocks are so cheap, and if demand comes back, the operating leverage would kick in so beautifully that for next 12, 18 months, maybe 24 months, you could be in for a very tactical kind of a trade. But every time I've interacted with you, you've purposely stayed away from that sector. I admire that you've stayed away from that sector, because in markets, if you don't do mistakes also, you make money, and I really appreciate this about you.
So look, I think there's a couple of things. One is the sort of age-old reason why we've stayed away, and the second is increasingly what we're seeing over the last couple of years. Let me start with the conventional reason why we've stayed away from sectors like cement and metals. Barriers to entry. It's not obvious to us that that tomorrow morning, if suppose there's a cement boom in our country, it's not obvious to us that another 100 million tons of cement capacity flows in. So yes, there's great cement companies in our country. I think Shree Cement is an outstanding company, brilliantly run company. But by and large, cement, to make money, you have to focus on efficiency as opposed to building powerful moats of the sort, say, an HDFC Bank or an Asian Paints or a Dr. Lal Path Labs has been able to build. So the inability to build powerful barriers to entry worries us, and that's why we've stayed away from commodity-oriented products like metals and cement. But the other part, Nikunj, is about how our country is evolving. If you look at how the money is coming in for capex, right? It's coming in for, say, for Jio. It's coming in from Google. It's coming in for Foxconn. Almost all the VC money in our country is for tech. So the entire thrust of our economy, the future of our country, the current capex boom, will be around brains, around technology, around science, around chemistry. Right? The old style capex stories that we used to have, which is, build a road, build a plant, put up 25 high rises, that is increasingly a capex story of the past. I mean, we'll still build roads in our country, we'll still build high rises, but the core thrust of our capex engine will increasingly become around tech, science, and basically around the human intellect, the Indian intellect, right? And unfortunately, these sectors, the ones that we are discussing, the commodity-oriented sectors, don't allow you and me to play the new wave of Indian capex, which is around the Indian mind, around the brains of our people.
Sure. So I'm just wondering about this renewed optimism around privatization. Government, it seems, pushing the paddle now on BPCL disinvestment. That's a big ETNA exclusive. You can see all the excitement as well play out in the stock since we broke the story yesterday during market hours. That aside, we've also heard chatter on a lot of other PSU candidates being picked up and looked at for privatization. Do you think there is an investment here, or do you think lots still on the table, given the market environment, given the delay that we've already seen in the privatization process, investors need to steer clear of this space right now?
There's two parts to it. Clearly, the government needs the fiscal boost from privatization. To be fair to the FM, she made this clear even a year ago. It's a different matter that they haven't been able to get anything sold. But the government's financial need for privatization, I think, was never greater. Given the increasing spend that we do have to do around defense and security, you could argue there's now a structural need for India to get rid of, let's put it in the perspective, non-core companies for the sovereign. I think increasingly will go on the block. And I think that makes sense at a lot of levels, right? We need to spend on, the government needs to spend on health, education, defense, rather than getting petrol to you and me. Now, the challenge is from an investor's perspective. A minority shareholder who has to go out and buy BPCL and hope and pray that a bid comes through, I just find that incredibly speculative. I would much rather go back to the themes that Nikunj was talking about, plays around, say, healthcare, and choose well-run companies who have built moats around what is clearly a basic human need. Just to buy BPCL, I'm not saying BPCL is an attractive company. Arguably, it's the best of the OMCs. Arguably, it will find bidders from, say, Rosneft or from, say, from the Middle East, right? But to buy BPCL on the premise that it'll get privatized, that'll make money, sounds to me to be a punch too many to make in what is already an uncertain economic scenario.
Yeah, absolutely. Okay, let me quickly walk you through what the market is up to. Still pretty sedate, I would say. About a 7/10% move. What you are seeing traction in is definitely the broader markets. Indiabulls Housing, Voltas, NMDC, Bosch, SAIL, these continue to be the pockets which are seeing traction, definitely. What's IT then up to? Is that seeing a bit of a pause? Wipro down today, TCS as well, just ebbing off that wee bit, Infi taking a pause, TechM as well taking a pause as we speak right now. Britannia, ahead of its numbers, let's look at this story where that's up to, holding up a solid 1.5%. Sort of time and again, we've revisited the entire consumption story. We all know we've consumed way more biscuits and cookies than we ever would have had it not been for the lockdown. But that aside, this entire theme playing out wherein the rural trends are fast emerging and recovering way faster than urban. Do you really think for FMCG players, valuation aside, can rural really compensate for the urban demand and help with volume growth?
So I think what's very interesting about I think a couple of sectors, FMCG, and I'll also bring auto into play. For both of these sectors, we've seen the rural-urban dance play in favor of rural, say till 2013 odd, and then tilt from rural to urban for the last 6-7 years odd, right? Given that the majority of our population lives in rural, I always used to feel that when rural comes back again, it will be a pretty sharp swing back to rural. So I think there's two dimensions to it. I think for those of us who live in cities and have been hit hard by COVID, clearly savings rates are going up. You can see this in the data that SEBI is publishing on how many brokerage accounts are opened. I can see this in the sorts of flows our company is getting. Savings rates in our social strata are clearly improving. Insurers are benefiting, general insurers are benefiting. So therefore, urban consumption, I think, will be a little bit more sedate over the next couple of years. Rural, on the other hand, 2 good monsoons. Government has been proactive in doling out money to rural. And we've got a whole clutch of elections in Hindi-speaking states coming up over the next 3 years or so, right? The Indian election cycle is skewed. The last 3 years of the 5-year cycle always sees the heavy-duty elections in Hindi-speaking states. So whichever way I cut it, I think a swing in the needle back from urban to rural, both for FMCG and for auto, I think seems to be on the cards. And we are hearing this from the FMCG companies and from the auto companies. And I think this is going to be a very powerful trend. Whether it will compensate entirely, I'm not so sure, Aisha. But I think there will be a pretty punchy story, an optimistic story to be told about rural for the next couple of years for both auto and for FMCG. And we're seeing this not just in the frontline auto companies. Escorts, a recent addition to our portfolio. When we were researching Escorts, the sort of feedback we were getting from rural Tamil Nadu to rural Punjab was just tremendous. It was just astonishing to hear through June and early July, the punchiness of rural demand, whether it's in South India or in the fields of Punjab.
Sure. Saurabh, just as we sort of come to the last couple of questions, in terms of the overall commentary so far, it's been very positive, and you've talked about a gradual reopening with the on and off lockdowns and so forth. But do you feel at all perhaps being over optimistic, given that we're still not completely in the clear? I'm just trying to play devil's advocate for a moment.
You should. I mean, look, in a way, we are lucky in the jobs that we have. Our job is to focus on the champions, buy the winners. And as I've discussed on your channel for several years, right, in our country, what's happening is good for people like us, but tragic at another level. Every sector is consolidating into the hands of 1 or 2 champion players, whilst hundreds of other companies get washed away. We will see that. We are seeing that through these months of semi-lockdown, and even after the lockdown ends, we'll continue seeing this trend where well-run, efficient, well-capitalized companies consolidate share, and that in turn means difficulties for hundreds of companies. So let's not wish away the fact that there's a broader story of economic pain, even as certain companies make a lot of money. So it is a balance. Our job is to focus on the winners, and hence we try to A, stay positive, and B, focus extensively on understanding why the winners are winning, what are their modes. But there is a broader story of challenge, difficulty to be solved. For the broader economy to come through, we'll need the government to continue doing the sorts of reforms they announced through COVID. We need to see privatization, as Aisha was referring to. We need to see the PSU banks being privatized more than BPCL, if you ask me, because without the PSU banks being privatized, our financial system is withering away. And most of all, we need to create an ecosystem where smaller companies can become efficient and participate in the global economy. We simply haven't done that. Cost of capital is too high, cost of labor is too high, cost of land is too high. Now, those are broader structural reforms. The government has done some of it. We remain hopeful other bits will happen post-COVID. And without those pieces, it's difficult to see a broader economic recovery, which brings us back to 7% growth. But for now, our job remains to focus on the winners and continue making money from them.
Saurabh, a space which has very well defined and very well recognizable winners and perhaps have only one or two players is the entire platform space, be it MCX or something like India Energy Exchange. Would you be buying any of the so-called platform companies, because that's the rage now, whether it is buying through MCX or India Energy Exchange, or for that matter India Mart? I think that's also in platform.
We did a lot of work actually on this space in the early part of the lockdown, because valuations had come up, and we looked at it quite long and hard. We struggled to convince ourselves, right? So some of them don't make actually any money on their day-to-day trading. They're basically making money on treasury income. And others are basically reliant on the regulator to give them a monopoly. They themselves don't have a natural monopoly. The regulator's given them a monopoly. The day the regulator decides, I want some competition, the monopolies go away. We looked at the quality of the technology platforms they built. It wasn't a pretty story, and hence we walked away. But it was very tempting. We looked at it. We spent a good couple of months looking at all of these platform plays, but we couldn't find any one which convinced us that there is a long-term money-making story. They make around 20%, 22% ROCs, but it's very the ROCs are basically dependent on regulatory protection. You take that away, it's game over.
Great way of looking at things. That are you enjoying a natural business mode, or are you enjoying a regulatory mode? I'd appreciate your time, Saurabh Mukherjea. Thank you for joining us.